Good morning, traders. This is your Forex market commentary brought to you by ECN. Wrapping up this week's trading session, if you're trading the dollar-yen pair, I hope this commentary can prove to be insightful for you to formulating your successful trading strategy. First, in line with today's discussion, we will break down this week dollar-yen rally past the 103.00 level and how this is related to risk appetite. Also, a lot of our listeners are anticipating this Friday U.S. non-farm payroll print, by which we will touch on and examine current market expectation on the outcome of this print. First, in line with this discussion, we are going to closely break down the dollar-yen market on the technical level. Analysts are expecting the dollar-yen to shy away from the 103.00 resistance at 23.6% retracement ahead of Friday release of U.S. non-farm payroll. The release of U.S. non-farm payroll has always been a volatility-inducing event. Therefore, most retail traders tend to wait out and avoid entering into this trade prior to the release and wait for a trend to break out to determine the entry points. According to the SSI, which is also known as the Speculative Sentiment Index, the retail sentiment on the dollar-yen cross has been relatively bullish, with 1.22 long dollar-yen position for every one short position out there. During yesterday's trading session, the market saw the dollar-yen pair broke out from the critical 102.75 level, thus exposing the pair to further rally with a year-to-date high of 105.43 as the new target if this bullish rally continued to maintain momentum. Traders are also looking at the S&P 500 as well as the Nikkei 225 performance as gauge for mapping out future dollar-yen rally. Analysis of a collection of technical indicators on the hourly time interval on the dollar-yen market suggests a temporary bullish market sentiment and recommend long positions on the greenback. The dollar-yen cross began Friday's trading session inching closer to the Fibonacci resistance at 103.09, and the hourly chart established short-term Fibonacci support at 102.99. Since the beginning of this week trading session, the dollar-yen market bottomed out on the intra-week low at 101.25 before tracing all of its previous losses and rallied past the 102 and eventually break out from the 103.00 level on the return of risk appetite. This bullish momentum can be characterized by the pair trading above the upper Bollinger Band numerous times, which is often considered as signals that this rally is underscored by a strong bullish bias. This new price discovery has allowed the pair to break out and above the 200-day simple moving average. This trend action holds great significance as 200-day simple moving average contain more or less of 1 year's worth of trading data, and it can forecast long-term market sentiment, and currently the pairs are trading above the 200-day simple moving average, which is indicative of a long-term bullish market sentiment. This bullish market sentiment is also validated by the dollar-yen pair opens today's Sydney trading session above the 5, 10, 20, and 30-day simple moving average, which is indicative of a buy recommendation on the moving average front. So moving along to the fundamental front on the dollar-yen market, the dollar-yen cross is an interesting currency pair since both currencies are considered a safe haven and the Japanese yen is often used as the denominator in the funding of a carry trade into riskier assets such as high-yielding euro or Aussie dollar. In terms of measuring market sentiment towards risk appetite, it is considered to be highly sensitive. Over the past months, leading economic indicators from Japan has shown sign of improvement, with the respective BOJ, through its rhetorical, has shown sign of its reluctance to pursue further easing policy. Now the market is coming to a realization that the BOJ may no longer intervene in the currency market to depreciate the Japanese yen. Therefore, any dollar-yen position must be made on the basis of two factors. One, which is the high-yielding differential between the currency trade, and secondly, the return of risk appetite as geopolitical conflict between Russia and the Ukraine has subsided. However, it is also important to consider that the global benchmark rate across the OECD banks are at their record multi-year low. Therefore, Japanese yen carry trades chasing yield differential appear to remain unattractive at present day. This leaves risk appetite as a driving force behind the dollar-yen momentum. This week dollar-yen rally is a clear indication that risk appetite has returned, but to what degree does this conviction hold remains to be in question. As of lately, the market sentiment on risk-on, risk-off trade continue to change from day to day. As of lately, the world's largest pension fund, known as the GPIF, which is the Japanese government pension investment fund, is shifting their investment portfolio from a domestic-centric investment to high-yielding asset overseas to keep up with rising inflation. The strategy of domestic investment during the era of deflation and stagnated wage growth is no longer working, as the economy is showing signs that moderate inflation gain is gaining traction. This diversification into riskier assets will prove to have a depreciative effect on the Japanese yen. The last risk event on investors' agenda this week is the U.S. non-farm payroll report, which will be released on Friday. Despite the greenback weakening across the broader forex market, including against the Great British Pound, the Aussie dollar, and the euro, it rose against the Japanese yen ahead of the U.S. non-farm payroll release. What this implies is that the market sentiment towards this report has been pessimistic, despite the U.S. jobless claim dropped to a 3-month low. The prior reading for the month of January showed that U.S. non-farm payroll only added 130,000 jobs, with high expectation that for February, the U.S. labor market will add an additional 190,000 jobs. The threshold of this is 115,000 jobs, and anything below this number would bring into question the credibility of the Federal Reserve tapering program. Recent release of February leading economic indicator and the extreme weather in the northeastern part of the United States had the market expecting the outcome of the U.S. non-farm payroll print to be lower. If the print can rise above 125K print, the market can observe further dollar-yen rally. However, if the print falls short of 100K print, then the potential for dollar-yen to retreat back to 102.00 zone is deemed to be plausible. Support for a stronger non-farm payroll print can be backed up by 3 upbeat recent economic indicators. The first one being the University of Michigan consumer sentiment, which rose. Secondly, the Challenger job cut report fell by 24.4%, while the continuing jobless claim number fell from 2.933 million outstanding to 2.907 million. However, on the other end of the spectrum, there are numerous indicators that support a weaker non-farm payroll print, and these include the non-manufacturing IMS employment dropping to record low seen during the 2010 recession, as well as a drop in ADP non-farm payroll number. Also leading this bearish view are the conference board consumer confidence, which also declined, and this decline was extended to the employment component of the manufacturing ISM print. I want to thank all of our listeners for spending our time with us. Until then, stay tuned and have a great weekend, everybody.